You've handed us the keys to, well, one of the most talked about technology companies in the market right now, Pacific Technology A Show, or PTA Show as we'll probably call it.
Yeah, that's right. And today, we're tackling their consolidated financial reports. These are for the first 9 months of 2025.
So that's the period running from, what, January 1st through September 30th.
Exactly. And they're dense. Our job here is to take all that complexity and turn it into something clear, a narrative, really.
A narrative that makes sense for you, the listener.
We're going to dissect their operational realities, track these massive investment moves they've been making,
And critically examine where those big headline-grabbing profits are actually coming from. Because that's key, isn't it?
Absolutely. That's the mission. We're aiming to go way beyond just the surface summaries.
Right. We want to deliver the truly critical facts, those financial health markers that, really matter if you're an individual investor looking at this company.
Cut through the noise, basically. Make you well-informed and quickly.
Okay, but before we dive into the actual numbers, there's something really important we need to get out of the way first. It's about the accounting.
Oh, definitely. A critical context point, especially for reports coming out of Turkey right now. All the figures we're going to talk about today, they're presented based on the purchasing power of the Turkish lira as of September 30, 2025.
And why is that?
It's because of the mandatory application of TMS 29. That's the standard for hyperinflation accounting.
So this isn't just some technical footnote you can skip over.
Not at all. It's fundamental. It means that when we compare, say, a 2025 number to a 2024 number, we're actually comparing genuine growth or decline.
Not just seeing figures bloated by inflation.
Exactly. It strips out that inflationary artifact effect, so we're comparing apples to apples in constant purchasing power terms.
Okay, that inflation adjustment is the central groundwork then.
Got it.
Now, a quick word to you listening in.
If this analysis, this deep dive, gives you that knowledge shortcut you need,
If it saves you maybe hours of wading through reports and gives you that aha moment.
then we'd really appreciate it if you hit that like button, subscribe to the channel, maybe share this deep dive with someone else who might find it useful.
Yeah, your support genuinely keeps our deep analytical engine running.
Okay, so let's get started. Let's ground ourselves first. Before we even look at what they earn, let's make sure we're clear on who Pacific Technology A actually is. #Tech2. Who is Pacific Technology A company, profile, and scope?
Right. So Pacific Technology, or PTA, it's actually a relatively young company, isn't it? Established back in 2015.
It is, but interestingly, it started life very differently. Its original name was Pacific Meskin Insha Tahut A.
Meskin Inshat. So like housing construction.
Pretty much. It's a fantastic example of a company making a really dramatic pivot. They only formalized their current identity, Pacific Technology A, quite recently, in July 2024.
That's a major shift. So their identity now is firmly in the high-tech space.
Absolutely. Their physical base is in Istanbul, specifically in the Vadi Istanbul Park Sitesi in Sarıyer. Nice address.
But their ambitions seem much broader than just Istanbul.
Oh, definitely. They position themselves broadly across what's called the Bilishim sector, that's IT, but the real strategic focus, where the big money seems to be flowing, is into the defense industry.
And they operate nationally and internationally in these areas.
That's the claim, though, as we'll see, the international side seems pretty nascent right now.
Okay, so if we break down their core business areas, what does that look like? It sounds quite diversified.
It is. They're targeting cybersecurity, which is, a massive area globally. Then there's software and consulting, computer, hardware, and technological infrastructure. And then, interestingly, they also list international trade and logistics.
That last one feels a bit different from the core tech focus.
It does. It might be legacy or perhaps supportive. The reports don't detail its significance much, but the main picture is this diversified tech conglomerate, not just a single product company.
What seems really crucial here, though, is how they define themselves.
Exactly. PTA actively markets itself not just as a company that implements tech, but as a genuine R&D and digital transformation innovator.
They really push that R&D angle.
They do. And they back it up partly by having a base in the Istanbul Bilishim Vadisi Technopark.
Why does that location matter for someone looking at the company?
Well, technoparks in Turkey often come with significant advantages. Government incentives, tax breaks, easier access to skilled engineers and researchers. It signals a serious, long-term commitment to innovation, often supported by state policy. It says, we're investing here for the long haul.
Okay. And when we're looking at these financials, this deep dive, it's not just PTA She's standalone, right? It's consolidated.
Correct. We're looking at the whole PTA ecosystem. The report rolls up several major subsidiaries, and understanding what each one does is pretty key to figuring out where the revenue actually comes from.
So let's run through the main ones.
Okay. First up, there's Destel Bilişim Çözümleri. PTA owns 100% of this one. It's based in Ankara and seems focused squarely on software, network infrastructure, and cybersecurity, kind of the traditional IT services side.
Got it. What else?
Then you have Ditravo Digital Hizmetler Platformu, also 100% owned. This one specializes in software development, specifically for the travel and passenger transport sectors. A bit more niche.
Interesting. Any others in that sort of IT space?
Yes, there's Credible Yazılım Technology. Here, PTA Show holds a 55% stake. They seem to be in the general IT and consultancy space as well. So these three kind of form the, let's say, the Bilişim backbone.
Okay, but you mentioned defense being a major focus. Where does that come in?
That's primarily through Intertwined Technology. This subsidiary looks like the heavy hitter, the future-facing part. It deals with software, AI, industrial control systems.
And it owns other defense-focused companies, too.
Right, like Teacher Savunma and Sevex Technology are under its umbrella. Now, interestingly, PTA Shoek's stake here is listed as 48.37%.
So less than majority control.
Not quite. The report specifically states they retain control. This is done through those special A-group shares we'll talk more about later. They might own less than half the equity, but they hold the reins strategically.
Ah, okay. That's a crucial detail. And wasn't there a big acquisition during this period?
Yes, a really significant one. In February 2025, right in the middle of this reporting period, PTA acquired a 51% controlling stake in Proline Bilişim Sistemleri.
And what does Proline do?
They're specialists in secure documents and biometric solutions. Think things like fingerprint scanning, vein recognition, face recognition tech.
Wow, okay. So that instantly gives PTA a serious capability in high security identification.
Exactly. That's valuable for government contracts, secure facility access, financial services, lots of applications. It's a major strategic move.
Seems like a classic inorganic growth play, instead of spending years developing that tech internally.
They just bought a controlling stake in a company that already has it. It shows a very aggressive M&A mindset from management. They're not just waiting for organic growth.
You mentioned international aspirations earlier. Is there anything concrete there?
Well, the report mentions Pacific Group BV, based in the Netherlands, with a 90% stake. But it's explicitly noted as being dormant, and it's not consolidated into these financials. It's carried at cost.
So for now, the international footprint is basically zero in terms of actual operations impacting the numbers.
Seems that way. The growth story we're analyzing here is overwhelmingly domestic, driven by organic sales growth and these big acquisitions like Proline.
Okay. And we can actually see this aggressive expansion reflected in their headcount, right?
Oh, yeah. The personnel numbers tell a clear story. They averaged 502 employees during these first 9 months of 2025.
How does that compare to before?
It's a big jump. At the end of 2024, they reported having 391 employees.
So they added over 100 people in just 9 months.
Roughly, yeah. That likely reflects a couple of things. One, integrating the staff from Proline after the acquisition. Two, hiring more people, probably high-skilled R&D folks, to push their own innovation strategy forward.
In the tech world, that kind of headcount growth is often seen as a necessary investment for future scale, right?
It is, but it also puts immediate, significant upward pressure on your current operational costs, salaries, benefits, office space, etc. And we'll definitely see the impact of that when we get to the profit and loss statement. Hashtag Tag 3, governance and financial foundations.
Okay, let's shift gears a bit. We know who they are and what they do now. Let's look at the capital structure and, importantly, the governance. Who's actually in control?
Right. Governance is just as crucial as the P&L, maybe more so sometimes. It tells you who makes the big decisions and, whose interests are being prioritized.
So starting with the basics, what's their capital setup?
Okay, PTA has a registered capital ceiling that's the maximum authorized capital they can issue of 3.4 billion Turkish lira.
And their actual paid-in capital, the money shareholders have actually put in.
As of September 30, 2025, that stood at 600 million TL.
That's 600 million. Was that always the figure?
No, actually, that represents a pretty significant internal strengthening. Just back in June 2025, it was only 134 million TL. They increased it using internal resources.
What does internal resources mean in this context? Retained earnings.
Likely, yes. Essentially, they beefed up the equity base without going out for external debt or issuing new shares to the public at that point. It can be seen as a sign of management confidence, reinvesting back into the company's foundation.
Okay, but the real governance story, the potentially controversial part, often lies in the ownership structure and the voting power, right?
Absolutely. And PTA has a structure that public investors really, really need to understand clearly. The controlling entity is Pacific Holding Able.
They hold.
They hold exactly 51% of the shares, just a simple majority of the equity ownership.
Okay, 51%. That gives them control.
But here's the twist. While they own 51% of the shares, they control a massive 71.45% of the voting rights.
Well, hold on. How does that work? Owning 51% but controlling nearly 72%.
It all comes down to a specialized share structure. They use A-group shares. Pacific Holding Eagle holds the majority of these specific A-group shares.
And these A shares have special powers.
Exactly. They carry disproportionately higher voting rights, especially on the most critical issues, things like electing the majority of the board of directors, approving major strategic decisions, mergers, acquisitions, things like that.
So it's a mechanism designed to keep control firmly concentrated within the Pacific Holding Group, even if they sell off more equity to the public.
Precisely. It ensures strategic direction remains locked in with the core holding company.
Okay, so for you, the individual investor listening to this,
Yeah.
you need to grasp this. The shares available for trading is actually quite high. It's 48.8% of the total equity. That's 293 million shares out there.
Nearly half the company in public hands, equity-wise.
But your ability as a public shareholder to actually influence the company's strategic direction is, well, pretty limited. You might own almost half the company, but you collectively hold less than 30% of the voting power.
It's not necessarily uncommon, especially with holding structures or family-controlled businesses going public, but it is a fundamental constraint. You're investing alongside a group that has entrenched control.
Yeah, it means you're essentially betting on the strategy dictated by that controlling group. It provides stability, perhaps, but limits shareholder activism or influence.
That's a perfect way to put it. Control is secure. Public shareholders are along for the ride, for better or worse.
Okay, let's quickly look at the people making those decisions then. The board of directors, the Yönetim Kurulu. Who's on it?
The report lists 5 members, just surnames given. Dur, Batuk, Denenmez, Demir Jer, and Yilmaz.
Right. And now for that standard governance check we always do. Diversity. Specifically, gender diversity on the board.
Yeah, we checked. The report is quite clear. Out of those 5 board members, 0 are women.
0 out of 5. So 0% female representation on the board.
Correct. And look, for a technology company positioning itself as this R&D innovator, potentially seeking international partnerships or investment, that lack of basic gender diversity at the highest level is, frankly, a notable corporate governance weakness by today's standards.
It definitely stands out. Okay, let's move on to how much this board is getting paid, executive compensation.
Yes. And this is a point that really deserves some scrutiny, especially when we layer on the operational results we're about to get into.
Why is that? What's the story with board compensation?
Well, the total compensation paid to the board shows a massive jump. And crucially, the report states it's not performance-based.
Okay, give us the numbers.
For these first 9 months of 2025, the total comp paid to the board was 5,762,307 TL.
And how does that compare to the same period last year? Remember, these are inflation-adjusted figures.
In the first 9 months of 2024, the board compensation was 1,731,456 TL.
Wait, so it went from 1.7 million to over 5.7 million. That's more than triple.
It is about a 233% increase in board remuneration in just 1 year, even after accounting for hyperinflation.
And you said it's explicitly not linked to performance. If the core business is struggling, which you hinted it might be, how does management justify tripling board pay without tying it to results?
That's the million-dollar question, or rather the 5.7 million lira question. It really signals a potential misalignment of incentives. Well, in a high-growth company, you expect executives to be well compensated, sure. But usually, big jumps in pay are linked to hitting specific targets, profitability, market share, successful project delivery, something tangible.
But here, pay triples.
Yeah.
And it's explicitly not tied to performance.
Right. So it raises serious questions for investors about, management's priorities. Is it tight expense control? Or is it rewarding the controlling group and the board regardless of the underlying operational health? It looks like a classic governance red flag that needs very close monitoring.
Okay. Shifting from compensation to investment. Let's talk R&D. They position themselves as innovators. Are they putting their money where their mouth is?
On this front, yes. They don't just talk about R&D. The numbers show they are demonstrably putting massive amounts of capital behind it.
A massive.
The R&D expenses booked directly in the profit and loss statement absolutely exploded. They jumped from 16.18 million TL in the first 9 months of 2024
Okay.
to a huge 85.39 million TL in the same period of 2025.
Wow, 16 million to 85 million. That's more than a five-fold increase in R&D spending in a year, inflation adjusted.
It is. This level of investment really is necessary if you want to seriously compete in cutting-edge areas like software, AI, and defense technology. They're spending significantly more on developing future products.
So this is the financial proof backing up their stated mission as an innovator.
Exactly. From a long-term perspective, it's a positive sign. It shows commitment. However, and this is crucial for understanding the upcoming results,
Uh-oh, there's always a however.
R&D expense is a current period cost. It hits the bottom line now. So as we foreshadowed, that 85 million TL investment in the future is going straight to work dragging down the company's short-term operating results. It's a necessary cost for growth, but it hurts profitability today. #Tag4. Operational performance and the profit paradox.
Oh.
P&L deep dive.
All right, let's get into the heart of it now. The core operational results. The profit and loss statement, or P&L.
Yes, and this is where that narrative of aggressive growth starts to really collide with the reality of their operational cost structure. It leads to what we're calling the profit paradox.
Okay, intrigue built. Let's start at the top. Revenue. How did sales look?
The top line looks fantastic. Sales revenue, or hasalat as it's termed, more than doubled. It showed 106% growth.
Doubled. What are the actual figures?
It went from 958.3 million TL in the first 9 months of 2024 to a very impressive 1.976 billion TL in the same period of 2025.
Nearly 2 billion TL in revenue in 9 months. The market is clearly buying what they're selling.
Seems so. And the composition confirms that strong domestic focus we talked about. Almost all of it, 1.993 billion TL, came from sales within Turkey.
Okay, if sales double, the cost of sales usually goes up too, did it?
Naturally. Cost of sales increased significantly as well, from 947.4 million TL to 1.722 billion TL. That's expected.
But the key is what's left over after those direct costs, right? The gross profit or brood car. How did that look?
Yeah.
Now, this is the first really major positive turnaround signal in the P&L. Gross profit absolutely soared.
Soared from what to what?
It went from being almost negligible, just 10.88 million TL in 9M 2024.
Wow, tiny margin then.
Very thin.
Huh.
But in 9M 2025, it jumped to an incredible 253.85 million TL.
Okay, that's a massive improvement. From 11 million to over 250 million in gross profit. What does that tell us?
It strongly suggests that after covering the direct costs of delivering their products or services, the company is benefiting significantly from scale. Or maybe the product mix shifted to higher margin items. Either way, their fundamental margins are dramatically healthier than a year ago.
250 million lira in gross profit. That sounds like the foundation for a successful business. It suggests the basic economics of selling their tech are pretty robust now.
On a gross level, yes, absolutely.
Yeah.
But here comes the operational red flag. We can't stop at gross profit. We have to look further down the P&L.
Right, we need to subtract all the other costs, the overhead, the R&D we just talked about, sales and marketing, admin. Exactly. Which brings us to the Isas Faliet Kari, the operating profit. This is the number that really tells you if the core day-to-day business is sustainable from its own operations.
And given that huge gross profit, surely the operating profit turned positive.
You'd think so, wouldn't you? But no. Despite doubling revenue and generating over 250 million TL in gross profit, the operating profit remained negative, and worse, it actually deepened.
It got worse. What are the numbers?
The operating loss went from minus 138.72 million TL in 9M 2024 to a larger loss of negative 175.88 million TL in 9M 2025.
Okay, that is the paradox. Revenue doubles, gross profit explodes by over 240 million TL, yet the operating loss increases by about 37 million TL. How is that possible?
It means the engine is running much faster, generating more power at the gross level, but the cost of the engine's housing, maintenance, and fuel the overheads are increasing even faster than that improved output.
So the day-to-day running of this whole consolidated group is still financially underwater, significantly so.
That's the operational reality, yes. About 176 million TL in the red from core business activities over 9 months.
We need to understand why. If gross profit improves so much, what specific costs blew out to overwhelm that gain and worsen the loss? We know R&D went up by about 70 million TL.
Right, R&D accounts for a chunk of the pressure, about 85 million total, but that
Yeah.
doesn't explain the whole gap.
So where did the rest of the pain come from?
The primary driver of the worsening operating loss is a massive increase in general administration expenses, or G&A.
Massive.
This cost category jumped from 101.4 billion TL in 9M 2024 to a staggering 293.34 million TL in 9M 2025.
Whoa, 101 million to nearly 300 million. That's almost a threefold increase in G&A costs alone.
It is, and that 293 million TL G&A bill completely swamps the 85 million TL R&D spend. It's the single biggest operational expense line by far.
Let's challenge that for a second. Management knows they're investing heavily in R&D. That pressure is planned. But why would they let general administration, head office salaries, rent, legal, accounting, the basic corporate overhead nearly triple in 1 year? Is that just core cost control?
It's likely a combination of factors, mostly tied to that aggressive growth strategy we've been talking about.
Like what?
Well, first, the Proline acquisition is huge. Integrating a whole new company with its own management structure, systems, office space. A lot of those costs get captured under G&A. That's unavoidable M&A integration costs.
Okay, that makes sense. What else?
Second, remember that tripling of board compensation we discussed? That 5.7 million TL? That falls into G&A.
Right. Small compared to the total, but indicative perhaps.
And third, just generally, rapid growth always demands more support functions, more complex accounting, more legal work, potentially higher executive salaries to manage the bigger entity. It scales up.
But still, a nearly 300 million TL G&A bill that completely wipes out a 250 million TL gross profit and pushes the company almost 176 million TL into an operating loss that feels structurally unbalanced.
When it is, regardless of the specific justifications, it points to a structural deficit at the operational level for this period. Long-term health requires getting those G&A costs under control relative to the gross profit being generated.
Okay, this operational deficit, this negative 175.88 million TL operating loss, it sets up the absolute central question of this entire deep dive, doesn't it?
It absolutely does.
How on earth does a company with a worsening operational loss of nearly 176 million TL manage to turn around and report a donum net carry, a net period profit attributable to the parent company's shareholders of a massive 1.035 billion TL for the same 9-month period?
Yeah, going from unachieved 176 million operationally to plus 1.035 billion on the net profit line. That's a swing of over 1.2 billion TL. Where did that come from?
It's a huge disconnect. This is where, as you said, we need to put on our accounting detective hats.
Exactly. If you're an investor, you can never just stop at the net profit line, especially when the operating result is so different. In this case, the net profit is almost completely divorced from the core operational reality of the business during these 9 months.
Okay, let's do it. Let's peel back the curtain on that 1.035 billion TL net profit.
Yeah.
If it didn't come from selling software or defense systems, it must have come from the financial side of the house.
Precisely. And the P&L confirms this dramatically. We need to look at the line item, investment activities income.
And what does that show?
It shows this is the main engine driving that net profit. Investment activities income surged to 1.642 billion TL in 9M 2025.
1.64 billion. How does that compare to last year?
It's a monumental increase. In 9M 2024, the income from investment activities was only 138.8 million TL. So it's gone up by nearly 1.5 billion TL.
Wow. A 1.6 billion TL investment income in just 9 months. For a company whose primary business is supposedly technology, R&D, and digital transformation. That sounds unusual.
It is extraordinary, and it's almost entirely down to one single, absolutely critical line item within that section.
Which is?
It's labeled Gerçe uygun der farkı karzara yansıtılan finansal varlıklardan kazançlar.
Okay, that's a mouthful. What does it mean in plain English?
It translates essentially as fair value gains on financial assets whose changes are reflected in profit or loss. And this line item alone contributed 1.608 billion TL to the profit.
So virtually all of that 1.64 billion investment income came from this one source. Fair value gains. Let's pause here. This is absolutely critical for you, the listener, to understand what exactly is a fair value gain in this context.
Think of it like this. PTA isn't just a tech company, it's also acting like a significant investment firm with a large chunk of its capital. We saw earlier they hold a massive 2.709 billion TL in what are classified as financial investments, mostly venture capital investment funds.
Right, those VC funds that invest in startups and private companies?
Exactly. Now, under accounting rules, like IFRS or TFRS, which Turkey uses, companies often have to value these kinds of investments at their fair value at the end of each reporting period.
Meaning what they're estimated to be worth in the market right now.
Pretty much. So if PTA Shen invested in a VC fund, and the fund manager determines that the underlying companies within that fund have increased in value, maybe a startup they hold got a higher valuation in a new funding round, then PTA Show has to reflect that increase on its books.
So let's say they bought into a VC fund for 100 lira initially, and 9 months later, based on the fund manager's assessment, that stake is now valued at, say, 160 lira.
Then that 60 lira increase in value has to be booked by PTA Show as a gain in its P&L statement for that period.
Even though they haven't actually sold the investment.
Correct. That 60 lira gain is essentially the 1.6 billion lira figure we're seeing here, just on a much larger scale. It's often called a mark-to-market gain, or more simply, a paper gain.
Paper gain, meaning no actual cash has come into PTA Show's bank account from this yet.
Precisely. They haven't liquidated the investment, they haven't realized the profit by selling. They've simply revalued their existing investment portfolio upwards based on current estimates.
Okay. So this non-cash paper gain is what's inflating the net income line so dramatically. It allows them to report that massive billion lira headline profit figure even while the core operational business is still losing money.
That's the crux of it. It fundamentally changes how you should view the quality of that profit. This company, in this period, made most of its reported profit not by selling more tech or improving operational efficiency, but by having its financial investment portfolio appreciate in value on paper.
That's a dynamic you'd expect more from a holding company or a pure investment trust, maybe less so from an operational tech firm claiming an R&D focus.
It certainly shifts the narrative, and there's actually a second, smaller financial gain we also need to factor in, which comes directly from that hyperinflation accounting standard, TMS 29, that we mentioned at the start.
Ah, the net monetary position gains.
Yes, the net parasol Putsisan Kazansalari. This contributed an additional 139.98 million TL to the profit in 9M 2025.
How does that gain arise? It sounds complicated.
It's a bit counterintuitive. Basically, TMS 29 requires you to assess whether you hold more monetary assets, like cash, receivables, things fixed in lira value, or monetary liabilities, like loans payable. If your non-monetary assets, like property, equipment, equity, and investments, things whose value isn't fixed in lira, exceed your monetary liabilities, you have a net non-monetary asset position.
Okay.
In a period of high inflation, holding non-monetary assets is generally better than holding cash or being owed fixed amounts of cash. At the same time, the real value of your fixed lira debts decreases due to inflation. TMS 29 captures this relative benefit as a monetary gain when everything is restated to the purchasing power of the lira at the reporting date.
So it's essentially an accounting gain that rewards having more inflation-resistant assets than fixed-value liabilities during high inflation.
That's a good way to think about it. It's another non-cash gain resulting directly from the accounting standard needed in this economic environment.
Okay, so let's do the litmus test then.
Right.
If we take that reported net profit of 1.035 billion TL,
Right.
and we strip out the 1.608 billion TL in unrealized fair value gains from investments, and we also strip out the roughly 140 million TL gain from the inflation accounting adjustment.
Yeah, take those away.
What are we left with?
You're left right back roughly where we started, around that megaver 175 million TL operational loss, plus or minus some smaller items. The picture completely flips back. The underlying sustainable business, based purely on its operations in this period, was not profitable.
Wow. So the conclusion on profit quality seems crystal clear then.
It really is. For you, the investor, especially if you're looking for profit that comes from recurring, sustainable, cash-generating sales of technology, that 1.035 billion TL net result figure is frankly quite misleading on its own.
It's growth driven almost entirely by financial valuation increases and accounting requirements, not by organic operational strength in this specific 9-month period.
That's the takeaway. You absolutely have to look under the hood here. Hashtag Tax 6. Balance sheet health, liquidity, and asset growth.
Okay, so we know the P&L shows this paradox. Great top-line growth, terrible operating result, but a huge net profit driven by paper gains. How did all this activity, the R&D, the acquisitions, the big investments, actually impact the company's financial position? Let's move to the balance sheet.
Right. The balance sheet gives us a snapshot of their assets, liabilities, and equity at that specific point in time, September 30, 2025. And the first thing that jumps out is the liquidity transformation.
Liquidity, meaning their cash position.
Exactly. Cash and cash equivalents improved dramatically. They went from having a pretty modest 8.3 million TL at the end of 2024.
So not much cash on hand then.
No, quite tight. But by September 30, 2025, that figure jumped to a much more robust 321.5 million TL.
Okay, so immediate cash liquidity doesn't seem to be an issue anymore. Where did that cash come from? We know operations were loss-making.
We'll get to the cash flow statement in a moment, which details the ins and outs. But first, staying on the asset side of the balance sheet, we've already touched on the source of those huge financial gains, and it's sitting right there as a massive asset.
The financial investments line item.
Precisely. That figure went from being practically nothing, just 58,600 TL at the end of 2024, to a staggering 2.709 billion TL by September 30, 2025.
2.7 billion lira in financial investments. That's enormous.
It is. It's now one of the single largest assets on their balance sheet, maybe second only to intangible assets like goodwill. And the nose confirmed the vast majority of this 2.7 billion TL is held in those venture capital investment funds we talked about.
So this confirms the strategic shift. The company has deployed a significant portion of its capital away from purely operational assets and into these financial assets.
Absolutely. It changes their risk profile, and as we saw, it dramatically changes their profit engine, relying heavily on those non-cash valuation gains from this 2.7 billion portfolio.
Okay, this brings us neatly to the cash flow statement. You often say this is arguably the most critical of the three main financial statements. Why?
Because it traps the actual cash moving in and out of the company. It ignores many of those non-cash accounting adjustments like the fair value gains or depreciation and just follows the money. Did cash come in from customers? Did it go out to suppliers for investments, for financing? It's the reality check.
And given the disconnect between the operating loss and the net profit, the cash flow statement here should be really revealing. What does it show? Let's start with cash flow from operations, section A.
Okay, now this is where it gets really interesting, maybe even contradictory at first glance. Cash flow from operations shows a massive positive swing.
Positive. How much?
It went from a large negative cash flow of negative 336.8 million TL in 9M 2024.
Meaning operations were burning cash last year.
Heavily. But in 9M 2025, it swung to a huge positive cash flow of plus 1.359 billion TL.
Wait a minute. Hold on. How is that possible? We just established the company had an operational loss of 175 million TL. How could it possibly generate nearly 1.4 billion TL in operational cash flow? That's a discrepancy of over 1.5 billion TL.
Yes. It looks like a complete contradiction, doesn't it?
Mm-hmm.
But the reconciliation is buried in the notes to the cash flow statement, and it's absolutely crucial to understanding what really happened.
Okay, walk us through it. How do you get from 176 million operating loss to 1.4 billion in operating cash flow?
All right, the statement starts with the net profit figure, which was that 1.035 billion TL.
Right, the one driven by paper gains.
Exactly. So the first major adjustment is to subtract the non-cash items that inflated that profit. The biggest one, by far, is that fair value gain on financial assets, the 1.6 billion TL paper gain. You have to take that out because no cash actually came in.
Okay, so starting with 1 billion profit, subtracting 1.6 billion paper gain. That immediately throws us back into a massive negative number, like minus 600 million or so.
Correct. Then you add back other non-cash expenses that were deducted in the P&L but didn't involve cash outflow, like depreciation and amortization. That adds back maybe 60, 70 million TL. Still deeply negative.
So where does the massive positive swing come from to get us to plus 1.4 billion?
It comes primarily from changes in working capital. Specifically, there's an adjustment line related to the increase in other operating liabilities. It's called something like Falietler Eligili Dider Borsordaki Artush.
The change in other debts.
Essentially, yes. And that single line item shows a positive cash flow adjustment of nearly 1.94 billion TL.
1.9 billion TL cash inflow attributed to an increase in other debts within the operations section. What is that debt?
This is the cash flow statement reflecting that massive increase in related party debt that we're going to discuss in detail very soon. The company received an enormous amount of cash inflow during this period, structured as loans from its controlling shareholders. Because these loans are funding the ongoing operations, covering the losses and funding working capital, they get classified within the cash flow from operations section under changes in liabilities.
Ah, so the massive positive operating cash flow isn't generated by customers paying bills or efficient operations. It's generated primarily by the controlling shareholders pumping nearly 2 billion TL of debt funding into the company during the period, which gets counted here.
That's exactly what it looks like. It's a cash injection effectively disguised within the operating cash flow figure due to accounting classifications. It dramatically changes the assessment of operational self-sufficiency.
Okay, that is a critical clarification. So, while the OCF number looks great, its source is primarily financing, not operations. What about the other sections? Cash flow from investing, section B.
That shows a large net outflow of negative 1.248 billion TL. This makes sense. It tracks where the company spent cash on long-term assets.
Where did that cash go?
A chunk went towards the Proline acquisition. The cash portion of that deal was around 188 million TL outflow, but the biggest outflow by far was for purchases of financial assets. That's where they spent the money to build up that 2.7 billion TL investment portfolio we saw on the balance sheet. So cash came in via related party debt and immediately went out into buying these VC funds and paying for Proline.
And finally, cash flow from financing, section C. This covers traditional debt and equity changes.
This section shows a net inflow of 204 million TL. The main driver here was that capital increase back in June that brought in about 447.3 million TL in cash. This is offset by repayments of bank loans and interest payments, leading to the net 204 million inflow from financing activities overall.
Okay, so the overall cash flow picture is massive cash injection from related parties, shown in ops, plus cash from a capital increase, shown in financing, which was then immediately deployed into acquiring Proline and building that huge financial investment portfolio, shown in investing.
That summarizes the major cash movements perfectly.
Let's look back at the balance sheet quickly, at the long-term assets beyond just cash and financial investments. What about intangible assets? Did they grow?
Yes, significantly. The net book value of intangible assets, things like developed software, licenses, and goodwill, soared from 735.8 million TL at the end of 2024 to 1.263 billion TL by September 2025.
What drove that half-a billion lira increase?
It shows both organic and inorganic growth strategies at play.
How so?
Organically, you see a big increase in developed projects. There were capital expenditures of 236.9 million TL added to this category in just these 9 months. This reflects that heavy R&D spending, the 85 million TL expense plus likely more capitalized development costs, actually hitting the balance sheet as assets being built for the future.
So R&D effort turning into balance sheet value. And inorganically.
That's shown in the goodwill line item, or SERIFI. Goodwill represents the premium paid for an acquisition above the fair value of its identifiable net assets.
And did that increase?
Yes, it went from 193.3 million TL to 306.7 million TL. That increase of 113.4 million TL is attributed entirely to the acquisition of Proline Bilisham. It's a clean marker of the M&A activity adding value, or at least recognized value, to the balance sheet.
Okay. One last major asset point to highlight that commitment to the defense sector via TETRA.
Ah, yes, that's important. Buried slightly under long-term assets, there's a specific line item showing 360 million TL classified as long-term advance payments for property and equipment.
360 million in advances. What's that for?
The notes explain this relates directly to the acquisition of a large plot of land, 35,000 square meters, specifically earmarked for building a new factory for the subsidiary TETRA Technology A.
The defense and UAV-focused subsidiary.
Exactly. So this isn't just talk or R&D spend. This is a massive, concrete, long-term financial commitment to building physical production capacity in the defense sector. It signals a very serious strategic direction for TETRA's future expansion. #7, debt, related party dependency, and future capital plans.
Okay, we've seen the company is growing rapidly, investing heavily in R&D, M&A, and financial assets, and has made a big bet on defense manufacturing capacity. Now, we absolutely have to address the elephant in the room. How is all of this activity being financed? Let's start with traditional debt, like bank loans.
Right. Looking at their liabilities, the total bank debt, combining both short-term and long-term borrowings from banks, stands at 303.1 million TL as of September 30, 2025.
How does that compare to the end of 2024?
It's up from 170.5 million TL. So they have taken on more bank debt, but not an astronomical amount relative to their asset base.
And is it mostly short-term or long-term? Any currency risk?
The vast majority is short-term. About 288.9 million TL is due within a year. And importantly, the report states that all of these bank loans are denominated in Turkish lira.
Okay, so that isolates them from foreign exchange volatility on this particular chunk of debt, which is good. 300 million TL in bank debt seems manageable for a company with billions in assets.
On its own, yes. It doesn't immediately scream danger, however. This relatively modest level of bank debt completely masks the truly critical disclosure, the defining risk factor for this company right now. Its immense reliance on related party debt.
Okay, this sounds crucial. Lay it out for us. Where do we see this?
We need to look closely at the total short-term liabilities section on the balance sheet. The total figure there is 4.429 billion TL. That's a lot of obligations due within 1 year.
And within that 4.4 billion.
The single largest component by far is a line item called Borçlar, which means other debts. This line alone accounts for 2.819 billion TL of the short-term liabilities.
Other debts. That sounds vague. What's actually in there?
This is where the critical detail lies. The footnotes break it down, and the composition is, frankly, shocking. Of that 2.819 billion TL in other debts, a massive 2.716 billion TL is explicitly stated as being owed to related parties.
Wait, 2.7 billion lira owed short-term to related parties, out of 2.8 billion in other debts. So almost all of it is related party funding.
Pretty much all of it. And compare that figure. At the end of 2024, the amount owed to related parties was only 517.3 million TL. So it has ballooned by over 2.2 billion TL in just 9 months.
Let's put that in perspective.
Yeah.
That 2.716 billion TL related party debt.
Yeah.
What percentage is that of their total current liabilities, the 4.429 billion?
It represents approximately 61%. Think about that. 61% of all the money the company owes in the next year is owed internally to its own controlling shareholders or related entities.
61%. That represents an absolutely extreme concentration risk, doesn't it? This company's immediate liquidity, maybe even its survival, seems utterly dependent on the willingness of a very small group of insiders to keep rolling over or maintaining this massive financing line.
It absolutely does. And the reports even provide specifics on the concentration within that related party debt.
Who is it owed to?
A combined 2.25 billion TL of that 2.7 billion is owed individually and in equal amounts to just 3 specific people: Fatih Erdoğan, Mehmet Erdoğan, and Abdülkerim Fırat.
3 individuals are owed 2.25 billion TL, so about 750 million TL each.
Roughly, yes. That's where the bulk of this short-term internal funding is coming from.
Okay, let's analyze the implications here for you, the listener. On the one hand, shareholder loans like this can be advantageous. They might be interest-free or carry lower interest rates than bank loans, giving the company cheaper funding and a short-term cash flow benefit.
That's the potential upside. Keep operational costs lower.
But the downside? The sheer size of this dependency, 2.7 billion, concentrated among just 3 people. It's staggering. What happens if those 3 individuals decide, for whatever reason, they want their money back, or they want to significantly change the terms?
It could trigger a severe liquidity crisis almost overnight. The company might be forced to rapidly sell assets, perhaps those financial investments, maybe even parts of the core business, or undertake a major, potentially painful financial restructuring just to meet those obligations.
It creates a fundamental structural vulnerability.
Yeah.
Any external lender, like a bank considering a larger loan, would surely flag this immediately as a major risk.
Without a doubt. This massive dependency really calls into question the company's overall financial independence. It suggests that while PTAS is successfully raising some capital publicly and making acquisitions, the primary engine funding its day-to-day operations and covering losses remains the private wealth of the controlling family or group.
It represents a huge commitment from them, yes, but it's an equally huge risk concentration for the company and its public shareholders.
Exactly. However, it seems management is acutely aware of this vulnerability and is actively moving to address it. We need to look at events that happened after this reporting period ended on September 30, 2025.
Okay, post-period events. What happened?
First, a positive development for the new subsidiary, Proline Bilişim. It received a significant external cash injection of 375 million TL.
From who?
From a fund managed by Neural Portföy Yönetimi a reputable asset manager. This provides fresh capital directly into that newly acquired biometrics and secure documents segment, and it also acts as a form of market validation for the acquisition price and strategy.
Okay, that's good news for Proline. But what about the parent company, PGA, and that enormous 2.7 billion TL related party debt?
That's the main event. The company announced a proposal for a major capital restructuring specifically designed to tackle this debt burden head-on.
What's the proposal?
It's for a huge 2 billion TL special capital increase, a massive injection of new equity onto the balance sheet.
2 billion lira. That would certainly make a dent in the debt. But how is this capital increase structured? Who gets to buy the new shares? This is critical for existing public shareholders.
Absolutely critical. And the proposal includes a very specific and potentially controversial mechanism: the full restriction of existing shareholders' preemptive rights, or Ruşan Hakları, as they're known in Turkish.
Okay, let's break that down slowly. What are Ruşan Hakları, or preemptive rights, and why does restricting them matter so much here?
Normally, when a publicly listed company decides to issue new shares to raise capital, existing shareholders have the legal right, the preemptive right, to buy a portion of those new shares, usually in proportion to their current ownership stake.
So if I own 1% of the company, I get the right to buy 1% of the new shares being issued.
Exactly. The idea is to allow existing shareholders to maintain their percentage ownership and avoid having their stake diluted by the new issuance.
But here, PTSGs are proposing to restrict that right.
Yes, they're asking shareholders to approve switching off that right entirely for this specific 2 billion TL capital increase.
What does it mean in practice?
It means that the new shares, the entire 2 billion TL worth, will not be offered to the public shareholders who own 48.8% of the equity. Instead, the shares will be allocated solely and directly to specific predetermined parties.
Okay, so who are the sole recipients designated to receive these 2 billion TL worth of new shares, shutting out the public?
It's the very same three individuals who are currently owed the bulk of the related party debt: Fatih Erdoğan, Mehmet Erdoğan, and Abdülkerim Fırat.
The ones owed 2.25 billion TL combined.
Precisely. The proposal is to allocate this 2 billion TL capital increase entirely to them in equal amounts, roughly 666.7 million TL worth of new shares each.
Ah, I see what's happening here. This
Yeah.
isn't really about raising new cash for the company, is it?
Not primarily, no. This is structured as a debt-for-equity swap.
Needy.
Meaning, if this proposal is approved and executed, 2 billion TL of the debt currently owed by the company to those three individuals will essentially be canceled. In exchange, the company issues 2 billion TL worth of new equity shares to those same three individuals.
So a huge chunk of that dangerous related party debt liability just vanishes from the balance sheet and gets converted into permanent shareholder equity held by the controlling insiders.
Exactly. It's a massive deleveraging event achieved through an internal restructuring.
What does this achieve for the company?
Several critical things simultaneously. First, it structurally addresses that number one vulnerability, the massive related party debt concentration. It significantly reduces the company's current liabilities and the associated liquidity risk. Second, it fundamentally strengthens the company's equity base, making the balance sheet look much healthier to potential future lenders or investors.
Okay, those are significant benefits for the company's stability, but what's the cost? Specifically, what's the impact on the existing public shareholders who are excluded from this?
The cost for the public investor is dilution. Because 2 billion TL worth of new shares are being issued only to the insiders, the existing public float's ownership percentage, that 48.8%, will decrease. Their slice of the pie gets smaller, even though the total value of the pie might arguably increase due to the reduced risk.
So they own a smaller percentage of a potentially more stable company.
That's the trade-off. They experience this non-cash dilution, although arguably their voting power dilution is less relevant since control was already locked in by the A Group shares anyway.
It's a significant restructuring.
Yeah.
Essentially, the controlling group is converting the emergency funding they provided as debt into a more permanent capital stake as equity.
Yes. And from a financial health perspective, swapping short-term, potentially callable debt for permanent equity is generally seen as a positive step towards long-term balance sheet stability. But it all hinges on getting shareholder approval for this restriction of rights and the swap itself. Hashtag tag 8, inventor summary and final takeaways.
Okay, we have covered a lot of ground here. Massive revenue growth, that huge but misleading paper profit, ongoing operational losses, heavy investment, and now this critical debt restructuring proposal. Let's try to pull it all together into a summary for you, the investor, based on these 9M 2025 results.
Right. First, maybe a quick look at how the stock market reacted during this period. What did the share price do?
The report notes that between January 1st and September 30th, 2025, the PTA share price traded in a range between 21.44 TL and 30.74 TL.
And where did it close the period?
It closed right at the high end of that range at 30.74 TL on September 30th. So clearly the market was reacting quite positively, likely to the strong revenue growth narrative and maybe that headline billion lira net profit figure, even if we've now unpacked the quality issues behind it.
Yeah, markets often react to headlines first. What about dividends? With such a huge reported profit, did the company return any cash to shareholders?
No, not at all. The company's stated dividend policy is quite flexible. It explicitly allows the board to decide whether to retain profits for investment or distribute them based on financial needs, investment plans, and market conditions.
And what was the decision regarding the 2024 financial year results, which would have been decided in early 2025?
For 2024, they distributed no dividend. The justification provided was quite technical but sound. Because of losses accumulated from previous years being carried forward in the legal accounting records, they didn't actually have a net distributable profit, as defined by law, despite whatever the consolidated accounts might have shown for that single year.
So the focus remains firmly on reinvesting any available funds back into the business, into that R&D, the strategic projects like the teacher factory expansion and funding operations. Cash is being preserved internally.
Makes sense given the operational losses. Okay, let's try to crystallize everything into a tailored SWOT analysis. Strengths, weaknesses, opportunities, threats, specifically focusing on what matters most from an investor's perspective given this unique financial picture.
Okay, let's start with strengths.
What stands out?
First, that undeniably aggressive top-line revenue growth doubling sales is impressive. Second, the monumental turnaround in gross margin, jumping from almost nothing to over 250 million TL, shows improving underlying unit economics or scale benefits. Third, there's a strong, verifiable commitment to R&D, evidenced by that 85 million TL expense. Fourth, their M&A strategy seems effective, successfully acquiring Proline to gain biometric capabilities.
Any other strengths?
The turnaround in cash flow from operations, going from negative 337 million to positive 1.36 billion, looks like a huge strength on paper, providing massive liquidity. But we have to put a huge asterisk next to it, knowing it was primarily funded by related party debt inflows, not actual operational efficiency. And finally, the long-term commitment to defense production via Tetra's 360 million TL factory land payment is a significant strategic asset build.
Okay, now for the flip side, weaknesses. W. What are the big concerns?
The most glaring weakness is that deeply negative core operational profit, negative 175.88 million TL. It signals the current operational cost structure, especially those ballooning general administration costs, is simply unsustainable without further massive scaling or significant cost cutting. Second, the heavy reliance of the headline net profit on those non-cash, unrealized financial gains, the 1.6 billion TL fair value increase. Profit quality is weak. Third, and perhaps most critical until resolved, is that extreme financial dependency on short-term related party debt, the 2.7 billion TL gear. It represents a severe concentration and liquidity risk hanging over the company.
And we should probably add the lack of board diversity as a governance weakness, too.
Yes, definitely worth noting.
Okay, let's look forward. Opportunities.
Oh.
What potential positives could drive future value?
The opportunities are potent. They are clearly investing heavily in future high-growth markets. Defense technology, Tetra, biometrics and cybersecurity, Proline. This is backed by that substantial 2.7 billion TL financial investment portfolio, which could generate future cash if liquidated or fund further growth.
And the big one related to the debt.
The biggest immediate opportunity is the successful execution of that proposed 2 billion TL debt-to-equity conversion. If approved, it structurally de-risks the balance sheet in a major way, potentially improving creditworthiness and freeing up future capital for operations or more investment, rather than just servicing related party debt concerns.
Finally, threats. T. What external or internal factors pose the biggest risks?
The primary threat remains those persistent operational losses. They simply have to be overcome eventually. If revenue growth stalls or G&A costs aren't contained relative to gross profit, the core business remains structurally unprofitable, regardless of financial engineering.
What else?
The concentration risk from the high related party debt remains a threat, even with the conversion pending what if the conversion fails or gets delayed. And there's always regulatory or market risk associated with relying so heavily on large, fluctuating fair value financial gains. Those gains aren't guaranteed. They can easily reverse in a market downturn, potentially leading to large losses in future periods.
Okay, that SWOT paints a picture of a company with high growth potential and aggressive strategies, but also significant operational challenges and major financial dependencies.
Which leads us perfectly into our final provocative thought for you, the listener, to mull over.
Go on.
Pasifik Technoloji has clearly demonstrated a mastery of financial engineering and executing an aggressive growth strategy through M&A and large investments. But ask yourself this. If the company were hypothetically forced today to strip away all the benefits from its financial maneuvering, if it liquidated that 2.7 billion TL investment fund, maybe at a discount, and had to rely solely on the cash generated from its core technology sales.
Could its operational model actually stand on its own 2 feet right now?
Based on these 9M 2025 numbers, the answer appears to be no. It would still be deep underwater, struggling under nearly 300 million TL in G&A costs relative to its 250 million TL gross profit.
So the ultimate structural question for the future is,
How long can or will the financial maneuvers, the paper gains driving net profit, and the continuous shareholder funding, first as debt, now potentially as equity, successfully prop up the valuation and mask that underlying operational deficit? The real stress test is yet to come. When does the core engine become powerful enough to run on its own fuel?
and for you, the investor, what's the key thing to watch right now?
Without a doubt, you must track the outcome of that proposed 2 billion TL special capital increase via the debt for equity swap. Its approval and execution are paramount. If it succeeds, the company effectively neutralizes its single biggest financial vulnerability, the related party debt concentration. This buys the operational side crucial time and breathing room to hopefully catch up and finally achieve sustainable core profitability. If it fails, however, that massive debt concentration risk remains critically high, potentially limiting future options.
A really complex but utterly fascinating deep dive into a company leveraging pretty much every tool in the financial and strategic toolbox.
It really shows how important it is to look beyond the headlines and understand the mechanics underneath.
Well, thank you for engaging with us in this comprehensive analysis of Pasifik Teknoloji A's 9M 2025 results.
Yeah, we hope this breakdown provided you with the clarity you needed, that knowledge shortcut through the complexity.
And if you found this discussion valuable, if it helped you understand PTA better, please do hit that like button, subscribe for more deep dives, and maybe share this with others who follow the market.
Your support really does help us keep doing this. Until next time, keep asking those hard questions, especially about the quality of profits.
We'll see you on the next deep dive.